Welcome to Tech Money Madness, your daily U.S. stock market podcast, March 31st, 2026.
Glad to be here.
Imagine standing in front of a burning building, right?
Okay.
But the fire department is just casually telling you it's a fantastic time to buy the penthouse.
Right, which makes absolutely no sense.
Exactly, but that is the exact contradiction we are staring down in today's market data. Welcome to today's deep dive, everyone.
It's a really wild landscape out there today.
It really is. I mean, we are looking at a scenario where skyrocketing recession odds and a massive geopolitical crisis are, happening simultaneously with major tech stocks just flashing these massive upside potential signals.
Screaming buys, basically.
Right. So we're unpacking the raw, unadulterated market sentiment from the daily briefing. And the mission for you, the listener, is to figure out how to navigate an economy where two entirely opposite realities are, well, they're playing out at the exact same time.
And, it forces a complete recalibration of how we measure risk. What makes this particular data set so revealing is the timing.
Because we haven't had any earnings, right?
Exactly. We had zero major corporate earnings reports over the past week.
So no PR spin.
None. There are no CEOs trying to, paint a rosy picture of their quarter. We are just looking at raw macroeconomic indicators colliding directly with institutional trading behavior.
Yeah, the raw data. So let's walk right into the macro storm. The big geopolitical elephant in the room driving everything right now is the Iran war.
Yeah, it's unavoidable.
The immediate casualty of this conflict is obviously the Strait of Hormuz. We are seeing severely stalled shipments of oil and, related products through that channel.
Right, because the global economy has this intense geographic vulnerability, and the Strait of Hormuz is the ultimate choke point.
I mean, it's barely 20 miles wide?
It's a waterway only 21 miles wide at its narrowest point, yet it handles a massive percentage of the world's daily oil consumption.
Wow.
So when tankers stop moving through there, it is an immediate global supply shock. And that shock translates mechanically into cost-push inflation.
Let's trace that mechanism for the listener, just so we're clear. Oil stops moving, so the spot price of fuel spikes.
Which instantly increases the cost of logistics across the board. The maritime freight companies, they have to pay more for bunker fuel.
Right.
They also have to pay exponentially higher insurance premiums just to put a ship in that region.
Which they obviously just pass right down the line.
Exactly. Those costs are passed to the manufacturers importing the raw materials, who then pass them to the trucking companies distributing finished goods.
So it hits everything.
Whether it's lumber, consumer electronics, or basic groceries, the physical cost of moving a product from point A to point B just surges.
Which sets a pretty grim stage for the hard economic data we need to look at today. Let's start with the U.S. deficit.
This is the crazy part.
It's insane. Through February, the deficit has already topped $1 trillion. $1 trillion, just 2 months into the year.
Yeah.
Now, the raw data does show this is running, slightly below the year-ago pace, but the absolute number is just staggering.
But the pace slowing slightly doesn't change the underlying mechanics of how a $1 trillion deficit actually impacts the private market.
Right.
When the government runs a shortfall that large, they don't just, magically create the money. The Treasury has to issue a massive amount of debt in the form of bonds.
Somebody has to buy that.
Exactly. Institutional buyers, we're talking pension funds, banks, foreign governments, they have to absorb that supply.
So they are essentially buying up government debt instead of deploying that capital elsewhere in the economy.
Precisely. It pulls immense liquidity out of the private sector. If a major financial institution is tying up billions in newly issued treasuries, that is capital not going into corporate bonds.
Right.
It's not funding venture capital, and it's not providing liquidity to the stock market.
It's just sitting in government debt.
Yeah. So to compete for that shrinking pool of available capital, private companies are forced to offer higher yields on their own debt. It organically tightens financial conditions across the entire economy.
Man. Which brings us to the inflation numbers, and we are looking at some seriously conflicting signals here that require some unpacking.
Yeah, the CPI and PPI split.
Right. So in February, consumer prices, the CPI, rose 2.4% annually.
Which was perfectly in line with expectations.
Exactly. But then you look at wholesale prices, the PPI, and they spiked 0.7% in the month of February alone.
It's a huge jump.
Right, pushing the annual wholesale inflation rate to a much hotter 3.4%.
And this divergence is, I mean, it's the most critical warning light on the macroeconomic dashboard right now.
Huh.
You have to look at the mechanical lag between those two metrics.
How so?
Well, the consumer price index at 2.4% measures what you and I are paying at the grocery store today.
Right.
But the producer price index at 3.4% measures what the factories and the distributors are paying for raw materials and shipping.
Ah, so that Strait of Hormuz supply shock we were just talking about, that hits the wholesale level first.
Instantly. When shipping insurance and fuel skyrocket, the factory pays more to produce the goods this week. That is the 0.7% monthly spike we saw.
But the consumer doesn't see it yet.
Right, because that factory usually has forward contracts with retailers like Walmart or Target. They cannot legally pass those price increases on to the retailer until next quarter.
Oh, wow. So CPI stays at a mild 2.4% for now.
Yes, but that 3.4% wholesale rate is basically a mathematical tidal wave heading straight for the retail shore. It usually takes like 30 to 60 days for a producer price spike to bleed into consumer prices.
And global forecasting groups are definitely seeing that tidal wave coming. I mean, they're officially expecting U.S. inflation to hit 4.2% this year.
Which is wild.
It crushes the Fed's own internal estimates. But here's where I am really stuck. Q4 GDP growth was just revised down to a sluggish 0.7%.
Barely any growth at all.
We are barely seeing any economic growth. Yet, traders in the futures market are actually pricing in a 52% probability of a Federal Reserve rate hike.
Yeah, a hike.
If GDP is practically flat, hiking rates feels like absolute economic suicide. How are traders justifying that?
Because the Fed is trapped by a dual mandate, right?
Yeah.
And inflation is the more immediate threat to the currency.
Okay, make sense for me.
To make sense of the macro environment, imagine driving a car where the driver is slamming the brakes while simultaneously flooring the gas pedal.
Okay.
The sputtering 0.7% GDP, that's the brake. The economy is losing momentum.
Right.
But the 4.2% inflation forecast is the gas pedal revving the engine to the red line. The futures market is betting that the Fed will be forced to hike rates.
To slam the brakes even harder?
Exactly, just to stop the engine from blowing up via inflation, even if it means risking a stall out into a severe recession.
Wow. So we have an economy facing a supply chain shock, a $1 trillion liquidity drain, and a 52% chance of a recession triggering rate hike.
It's a lot to digest.
It is. So how is this trickling down to specific sectors? Because, I mean, the energy sector is the obvious winner here. Valuations are climbing directly in response to the Iran war and the supply bottlenecks. The cause and effect are perfectly clear.
Yeah, energy valuations are simply mirroring the cost-push inflation metrics we just discussed. It is a highly traditional market reaction.
But the reaction in the consumer staples sector, that completely breaks tradition.
It really does.
Because when I think of consumer staples, I think of toothpaste, bread, milk, goods with inelastic demand.
Things people have to buy.
Right, regardless of what the Fed does. But the daily briefing highlights a major price hike from Netflix across all of its subscription tiers, and it classifies this under the consumer staples umbrella.
Yeah.
Since when is streaming considered on par with bread and milk?
Well, the classification has organically shifted because consumer behavior has shifted.
How so?
In a high inflation environment, true consumer staples possess absolute pricing power because the consumer has no alternative.
Okay, but think about your own budget right now. If
Yeah.
your monthly expenses go up by $100, you might switch from name brand cereal to the store brand.
Sure.
You might delay buying new clothes. But are you actually going to cancel the Netflix account or the high-speed internet package your family uses for 4 hours every single day?
The behavioral data shows you won't.
Wait, really?
Really. Over the last decade, digital subscriptions have become so deeply entrenched in the modern American household that they operate as non-negotiable fixed costs.
Oh, wow.
Netflix understands this psychological shift perfectly. By announcing a price hike across all tiers during a period of 3.4% wholesale inflation, they are boldly testing that pricing power.
Because they know people won't cancel.
They are betting that even with wallets squeezed by higher energy costs, their service is too critical to daily life to be cut.
That is a staggering redefinition of modern household inflation. I mean, we are feeling the cost push not just at the gas pump, but directly on our smart TVs.
Yeah, it's everywhere.
Which sets the stage for the most fascinating contradiction in today's data, what we're calling the tech disconnect.
This is where it gets really interesting.
We know the broader tech sector usually relies on cheap borrowing and flush consumers to fuel growth, right?
Usually, yes.
So with the macro environment looking so hostile, the broad index is taking a hit. The QQQ ETF, which tracks the Nasdaq 100, has fallen 8% from its all-time high.
And an 8% drop in the QQQ is a direct reflection of that 52% probability of a rate hike.
So they're feeling the gravity.
Exactly. Broad technology companies cannot escape the gravity of higher borrowing costs and a sputtering 0.7% GDP.
And this is a big but, when we stop looking at the broad ETF and zoom in on the micro opportunities, specifically the Magnificent Seven, the narrative flips completely.
It's a totally different story.
We are seeing major structural divergence. It's less a list of tech stocks and more of an AI infrastructure divide at this point.
That's the perfect way to phrase it.
Let's start with the spenders. Meta Platforms is up 2.03% today, leading the pack. The data notes Meta has the lowest valuation among the Magnificent Seven.
Right.
But Wall Street is actively terrified of their capital expenditures.
Meta is the perfect example of the tension in the market right now. Wall Street does not mind massive capital expenditure if the return on investment is immediate and obvious.
Which it isn't. Yeah.
No, Meta is buying tens of thousands of H100 GPU clusters and building massive proprietary cooling infrastructure to train AI models.
That is incredibly expensive.
It is, and the ROI timeline on that hardware is incredibly muddy. They are spending tens of billions of dollars, and institutional investors are demanding to know how a better language model actually translates into a measurable increase in advertising revenue this quarter.
Wait, so you're telling me institutional investors are looking at a company burning billions on hardware with zero guaranteed short-term return, and they are buying the stock anyway just because it's technically cheap compared to the rest of the sector?
Essentially, yes. They are pricing in the existential risk.
Existential risk.
Yeah. Meta's lower valuation reflects the risk that they might be overbuilding for a trend that won't monetize quickly enough.
Yeah.
But the stock is still up today because the market acknowledges that not spending that money on AI infrastructure basically guarantees obsolescence.
Right. You have to play the game or you die.
Exactly.
Which naturally leads us to the companies receiving all that infrastructure spending. If Meta is the one writing the checks, Oracle and NVIDIA are cashing them.
Very happily cashing them.
Let's talk about Oracle. I mean, Oracle has a breathtaking $400 price target right now. That is a 170% upside potential, driven entirely by strong AI data center fundamentals.
And this is because Oracle is completely shielded from consumer sentiment right now.
Explain that.
Well, they aren't trying to sell software to a consumer worried about Netflix price hikes, right?
True.
They are leasing the physical environment required to run artificial intelligence. Think about the electrification of the country in the late 19th century. Oracle isn't trying to invent the winning light bulb. They are laying the high-voltage wires.
So the infrastructure has to be built regardless of who wins the software war.
And regardless of what the Federal Reserve does. Even if the Fed hikes rates and pushes the broader economy into a recession, the biggest companies on Earth are trapped in an AI arms race.
They can't just stop building.
Exactly. They have to keep signing billion-dollar data center contracts with Oracle, or they die. That 170% upside is an analyst looking at Oracle's locked-in contract pipeline and realizing it is entirely decoupled from the 0.7% U.S. GDP growth.
It's just immune to the macro gravity.
Completely.
And I assume the same logic applies to NVIDIA. I mean, they are today's top losers. NVIDIA is down 1.40% today, and Tesla is down 1.81%. But the institutional perspective on NVIDIA is that this dip is actually a premier entry point.
That's right.
Because the broader QQQ index pulls back 8%, dragging NVIDIA down slightly with it, but the underlying demand for their chips remains insatiable.
For portfolio managers, a 1.4% drop in NVIDIA isn't a macroeconomic warning sign. It is a structural discount.
Oh, they love a discount.
They do. They are looking past the short-term noise of a potential rate hike and focusing purely on the supply-demand imbalance for specialized AI silicon.
It's just a screaming buy to them. Speaking of which, finally, we have Apple, highlighted literally as a screaming buy with a 28% upside potential.
Yeah, Apple is fascinating here.
It is trading with massive volume today alongside Microsoft and Amazon. If Oracle is the infrastructure play, Apple seems to be playing the role of the ultimate consumer staple.
Apple bridges the gap perfectly. They possess the pricing power of a staple because the iPhone replacement cycle is incredibly sticky.
Right, people are not giving up their iPhones.
Never. And their services revenue acts much like the Netflix dynamic we discussed earlier.
Fixed cost for the household.
Exactly. But they also have the balance sheet to weather a 52% probability of a rate hike without needing to borrow heavily in a restricted credit market.
So they don't even care about the tightening financial conditions.
Not really. A 28% upside suggests the market views them as the ultimate safe harbor if the macro storm makes landfall.
Man, okay. Let's synthesize all of this for you, the listener, because you are navigating a market that is fundamentally split in two right now.
Deeply bifurcated.
On the macro side, you have the heavy traditional gravity of an economy under immense stress. You've got an Iran war chopping off the Strait of Hormuz,
Right.
$1 trillion of government debt crowding out private liquidity, wholesale inflation sitting at 3.4%, threatening to wash over consumer prices and force the Federal Reserve into a devastating rate hike just to keep the currency stable.
And that gravity is real.
It is, and it is pulling broad indices down.
But on the micro side, you have fierce, targeted optimism.
Exactly. You have Oracle staring down 170% upside because the AI infrastructure build-out is immune to GDP metrics.
Immune to the breaks.
Right. You have Meta aggressively buying up GPU clusters, and consumers accepting digital subscription price hikes as if they were groceries. Alphabet is up 0.81%. It's just a different world.
I think the final provocative thought we need to leave the listener with is a question of structural permanence.
What do you mean?
Well, we're looking at a landscape where digital services have successfully adopted the pricing power of consumer staples.
Netflix is milk now.
Right. And where the demand for AI data centers operates completely independently of traditional economic growth.
Because it's an arms race.
Exactly. So do the old macroeconomic warning signs, the trillion-dollar deficits, the severe supply chain bottlenecks, the looming rate hikes, do they actually matter to these tech giants anymore?
That's the million-dollar question.
Or has big tech effectively built an entirely separate parallel economy that has figured out how to permanently ignore the gravity of traditional markets?
Wow, if gravity only applies to half the economy, the traditional rule book is obsolete.
It really is.
That is a massive paradigm shift to consider the next time you look at your portfolio.
Oh, your streaming bill.
Exactly, or your streaming bill. Keep questioning the data, look closely for the mechanisms driving the divergence, and stay curious until our next deep dive.
It's been great diving into this.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.